First of all, we have some good news regarding the oil price. So we're seeing the oil price moving above the 200-day moving average. I think it's crucial for the future of the energy sector, um, be it shale, fracking. If we're going into a sector, like if the sector will turn out to be like tobacco, for instance, or the so-called vice stocks that have, delivered huge returns for investors in the last 10 years. And I think there is an explanation for that. Like we heard about ESG is the future. But, people that investors that focus a lot on the E part, because a lot of energy companies have good governance, and the social impact, especially in some states of the US, is very significant in terms of unemployment. Have dumped all the energy related stocks. Some, like Norwegian pension fund, it's for the diversification reasons. Some is just because they are not allowed to invest in. So I think the investors that are left with, that are less constrained on that part, and are left with the opportunity, and I think a lot of hedge funds in this conference will be in that camp, especially the systematic one. There is an opportunity there, as those investors should be left with extra returns going forward. There is a possibility. The other possibility, and that would be a risk, is if going forward, energy sector would be the new, let's say, airline sector, which is the usual example for a sector that has destroyed capital for the last 50 years or maybe forever. And I think, there's two ways. No one knows where we will be going forward. I think there is an opportunity in energy stocks right now. Futures is tricky. We all saw the first future in, I guess, April, trading at minus 40. And James, you talked about the last panel about the physical delivery. There is some questions there. There was some questions regarding the ETF and the way they rebalance and the curve. So futures is tricky, but energy stocks are at the discount in the oil price. Of course, we don't know the reserves they have, if they're worth 40 or 100 or 20 or 10, or who knows, even less. But I think the opportunity is there, and also it has benefited from the so-called value to growth rotation. And energy is now 2.4% of the S&P. So even a minor slight overweight in the energy sector for some funds that are following more like momentum strategies, it can pump stocks a lot, and we've seen that in the last sessions, in the last few weeks. But I'll leave it to the other members of the panels to contribute and hear their thoughts.
Well, so I'll pick that up. So I mean, in terms of the energy companies, especially shale producers and the airlines that you mentioned earlier, shale producers have lost essentially about 320 billion since the start of the shale era in 2008. So there was a lot of talk about banning fracking or banning new production in federal lands from the new Biden administration. And from one side, that would be bad for production, but on the other side, that would probably be the best thing that ever happened to shale producers in terms of their actual earnings. I mean, in one sense, that would kind of be the equivalent of a non-illegal collusion. If they all got together and just decide we're not going to produce, which is according to antitrust laws illegal, if the administration did that instead and forced them to produce less, that would increase prices, and eventually, and believe it or not, would actually possibly lead to high production in non-federal land. So, you know, they could make money, and they could probably eventually keep production at the same level. So that, you know, maybe that would be the best thing for producers if they actually ended up banning fracking in federal lands. On the other hand, like, I'm not so sure that that's something that they will be willing to do, the Biden administration, because, you know, whether, even though they say that this is not the Obama's third term, it's pretty much almost the same people. And the way that the Obama administration, you know, behaved is that they did not announce the policies, that implemented the policies, and then they announced them. So kind of like the opposite of what the Trump administration did. They just announced them and then they implemented them, or maybe never implemented them. So you could see a similar pattern of behavior now, with them, you know, essentially not really announcing a ban on fracking, but just implementing it by, you know, delaying permits. You know, the easiest way to do that is through the BLM, Bureau of Land Management, and just, you know, kind of removing resources from that department and just making people wait 4 years for a new permit, and just, you know, increasing scrutiny in environmental protection, and increasing scrutiny in, you know, new regulation, which they can all do without the help of Congress. So, you know, in that sense, there's a lot that they can do, and they could be, and you cannot say that it's inherently negative or positive for the energy business, because, I mean, I personally believe that natural gas is a bridge to the future, to the, you know, environmental policy, because it has helped reduce emissions significantly when you compare it to coal. And it would be foolish, if I can use that word, to just remove natural gas from the stack completely without having the ability to replace it with something else in the form of, you know, wind or you know, solar or any other, you know, renewable energy. Because the backup, if you remove natural gas, is oil and coal, which are, you know, worse scenarios. So
yeah, I think to continue on that dialogue, and perhaps taking a slightly broader picture of the sector, I think you know, when we talk about energy, very often, yeah, we talk about energy, but then we treat it as if it was very much silos. And I think one of those massive silos is crude oil. For the longest time is operated in isolation, at least from a demand perspective, to the point that we've even confused things like transportation demand with oil demand, where people will look at them distinctively. And I think when you look at the bigger picture dynamics, what I would describe two phenomena, which is the battle for supply and the battle for demand. Clearly the battle for supply, which is this civil war, if I may call it, between technologies and producing countries. This is Canadian oil sands versus fracking versus ultra deep or whatever. This is a well-known battle, and I think it's assuming certain levels of demand. And I think over there, the big question with fracking obviously is to what extent this new kid in time has a global application beyond its obvious success in the US. And we're, I think, well aware of the risks or the limitations, environmental first, to make it applicable globally. But to the extent that the technology is there and it works, is obviously a game changer, and we'll see how that plays. But I think the other side of the equation, which links in with the natural gas comment from Everest, is the battle for demand, right? And I think here, when you think about oil in isolation and try to extrapolate transportation demand and global trends to oil demand, you know, we face issues such as, you know, peak oil demand, and how you could perfectly have a global transportation demand increasing, but oil demand staying flat, simply because you have new kids in town, new players, whether it's, you know, buses or trains going on LNG, to electric cars and everything. And whilst this in the short term might be missed, this is a marginal barrel game, and it's part of the reason why I think the you know, overly, I mean, I would paint a more conservative view on the oil upside based on some of these dynamics. where you get both the battle for supply kicking in with the potential for this technology and supply responses, but also the demand side, which is, as ever said, it has two coins, two sides on the ESG side. You know, the willingness for both cleaner supply and demand. So I think it's a fascinating field. I would agree with Nuno on the current levels and percentages and upside potential. There's obviously macro considerations such as inflation, but I think when it comes down to the micro picture, there's really quite a lot of uncertainty. And I think, you know, as Ever said, I think it's about the stack and the diversification. And I think the danger and the key point I was trying to make is that, you know, thinking about oil in pure isolation might be missing out some really, really important dynamics that lead to what I would describe as the flattening of the energy world.
So I mean, to continue that a little bit, I mean, the on the one side you have producers that have lost $320 billion of capital over the last 13 years, but on the other side you have consumers that have gained that and multiplied that by, you know, multiples of production, because, you know, the energy is an initial source, but then it comes back throughout the production. You know, it comes back to transportation as well. So it's an initial cost, but then it also costs of transportation. So the $320 billion gets multiplied from, you know, production to end user. So the economy, worldwide economy, has benefited many times over from whatever the producers have lost. And then that loss has been, it's not purely, you know, accounting like burned cash. It's been capitalized into the value of the wells. So you can think of that as it's been turned into an asset that, you know, frankly might never be recoverable, because that assumes like infinity production. But it's been a net benefit for the economy. Now, if you go with purely ESG and you just completely remove fossils, then that's going to be an immediate cost to the economy, which, you know, will hurt, you know, ESG investments as well. They will hurt the non-fossil fuel investments as well. So these ESG funds, if you think of that, like if you went 100% non-fossil fuel, then all their investments and everything else, like be it in banks or technology, that will be hurt as well, or long term. So there has to be a progression, you know, and a well thought out progression going from where we are now to where we maybe should be or we want to be in 10 years, but it cannot be drastic, and it cannot be, you know, with executive orders or immediate, you know, legislation. So,
George, I don't know if you want to comment on that, but I would add something regarding demand and supply, but I don't know if you want to add something on that front.
I mean, no, I think, you know, the interesting dynamic from my perspective is just that tug of war between the near term sort of demand implications in terms of what we're seeing with COVID, and the longer term, or let's call it medium term, supply demand dynamics with what seems like a tightening in the oil market specifically, which is what I know, draw from Asia, the factoring in of demand coming back from the vaccine, margins that are holding up, and just generally not high enough prices to induce enough US supply to come replace what was lost in 2022, let's say. And then going to what was referenced earlier on the longer end with these alternatives substituting in over time and sort of capping the upside of long-term oil price. So as a trader, I don't have any real answers to those things, but they're the tensions that I'm currently tuned in on. So I think the middle part of that curve is what's most interesting as a trader to me right now, which is to say that supply relative to on-ramping demand tightness as a potential opportunity to make money, with the context of, okay, well, we have almost no demand with these shutdowns in the front. And in the long run, I believe these alternatives are very much a ceiling on price in oil from a secular perspective. So not too much interesting to really add, just what I'm paying attention to with these type of themes.
I would just like to add regarding demand and supply, and more for like the big picture, and adding to whatever is said. I think in demand there's three crucial factors. One obviously is ESG, and namely EVs, and I've seen a lot of studies recently that demand for electric vehicles is underestimated. That and following on what Diego said, in the oil market that might be bearish, but for the energy as a whole, I wonder where that energy to supply the electricity that those batteries will come from, and I would like to touch on that a bit later. And I think the other main topic is, as mentioned by George, the COVID. So I think the big issue is, you know, we all hopeful that the vaccines work as well as they are expected to. Let's say we are up for, and the question will be, is it the old normal after spring, let's say next year, or summer next year, or let's say latest, we hope, early 2022? Is it back to the old normal, or is it a new normal with less travel? Of course, there's pent-up demand, so I think that summer next year might even be better than, you know, I wouldn't say this summer as the base effect is really favorable to compare. But like 2 years ago, there's pent-up demand, and I hear people are booking like summer holidays for next year like crazy. But the new normal will probably involve less traveling because we're all doing these conferences, and you know, I think nothing replaces face-to-face meetings, but I think companies will cut on some traveling expenses and so on and so forth. And there's obviously a revolution going on the auto sectors, and we just need, you know, to look at the auto companies and how they're trading in terms of PE and how they compare to Tesla, to understand how uncertainty the future for autos is. Like, you know, no one knows in 5 or 10 years, like, you know, how many cars will be on the road, like with all the Ubers and the sharing pools. So that's I think the most fundamental factors for demand, if like, as long as I know. And for supply, I would add to what Avery said, that the capex cut has been dramatic. Like Chevron just announced 27% decline from the earlier forecasts. That's less than half than the spending budget in 2014. ExxonMobil, the numbers I have, it's a fall of 46% from previous guidance. This is massive, and you know, will require at some point an increase in capex, but we have maybe a 30% drop from guidance and previous estimates. So I think we can have a supply shock. The other thing I would add is the numbers I have. So one of the big theses for oil coming down was the shale revolution. Have we seen peak shale? The numbers I have is like the production in the US has dropped from 13 million barrels a day to 11 million. The rig count numbers are down 70%. So we know that for the last years, that always underestimated like the effective shale production, because technology evolves, and we all know the rig count is not the best number to estimate the output. But actually, the shale, you know, production is already going down, and if prices stabilize at 30 or 40, I don't know how sustainable most of the shale industry is, and that might cause a supply shock. And then it's very hard to, you know, to balance all these effects. Like in demand, I think there's the risk of, you know, the base case scenario would be less demand than I would know that it was expected just a few months ago, for obvious reasons. But we also might be underestimating the supply shock in 2 or 3 years with all the companies that went broke. We all know the Chesapeake story, more in natural gas, the ex-Ensco, Rowan, Valaris. There's been a lot of mergers and acquisitions, but long story short, the supply is going down. Then we have OPEC and how much they will rise, and a lot of countries, probably will meet up that fall in demand, in supply. But I think the shale revolution, I wouldn't say is gone, but we might have seen peak shale, and I would love to hear the opinion of the other panelists, because of course I'm not sure. It's just my view.
I think your point about supply shock is definitely what I'm most sensitive to, right? For the story sort of beyond the next 6 months, I think you're absolutely right to highlight that. I guess I'm showing a little bit of philosophical bias, but these are such dynamic interactions. But when you start talking about, I'm speaking to oil, but I'm sure it generally applies to these types of markets, which is the tug of war between, let's say, the OPEC effects, COVID effects, the demand ramp, the international aspects of the demand ramp, the supply shock, fracking, all these different, very difficult to piece together effects. It's, I would say, almost impossible to model. So what I'm looking at is allowing spreads to sort of speak the net truth in fairly real time as we're going through this path. And I think as we're starting to see, oil, if it goes into backwardation and how OPEC reacts to that, that's where the trading opportunities in the near term for me will be. So I very much, from a narrative perspective, am watching demand from coming back from COVID, supply in terms of the supply shock you were referencing, also OPEC adherence, which has been quite good recently, and then allowing spreads to kind of give me the net balance of the story in place of trying to model it, which I think will be next to impossible a priori. Of course, there's an entire industry dedicated to doing that, and I wouldn't claim expertise in doing it any better than any of them. But as a trader, I think that's where the source of truth will be.
I would echo George's view, certainly to the extent that the flat price can be telling you a bit of a misleading story relative to spreads, particularly time spreads and also relative value. And I think they're just looking at time spreads and the drivers. You currently have a bit of a contango in the front end, and then some backwardation. We have different incentives, different players. Obviously the investor community coming through things like the ETFs that might be more front-loaded futures is really hurting potentially from this. And I think some of the people listening to this must understand exactly what they're buying. Earlier in the year, I got lots of calls from friends and everybody who wanted to buy oil, totally unaware of the contango and the permanent loss of capital that is incurred in these processes. And this is something that is super relevant, and it's still showing you part of the story, which is related to, yes, inventories might be tightening, but they're still very high, and you have this demand that in the short term has this negative carry. At the same time, OPEC obviously will love a backwardated market. They want to keep the new players and the hedging as the least attractive possible. So they want that back-end price of oil to be low, and they want to enjoy the surfing that wave. And I think all these dynamics, to George's point, are very difficult to all-in model, but the curve is telling you a lot of stuff. And the other thing that I think is critical before we get overly bullish on crude is the refined products. At the end of the day, we talk about oil all day. Nobody here uses oil. We all use diesel and gasoline and jet and whatever. And the reality is those margins are extremely depressed. They're off the lows, but it's almost like in order to have a proper move in crude, you will need that piece of the puzzle to come in as well, and I think that's yet another piece that ties in closer to nat gas and other pieces that we talked earlier, which I think every day that goes by, and Nuno, you touch on EVs and others, it's the energy world is getting flatter. You know, you have a lot of more competition in between, not only the supply side but the demand. And I think these forces mean that you have to think about energy as a whole, and what we need as investors, or as consumers. Nobody needs oil per se. I mean, many oil companies forget that. We need cheap transportation that takes us from A to B. I mean, at the cheapest price, most reliable and cleanest way. And this is the real game, and why perhaps some of the oil companies themselves are taking this very proactive effort, which might look super bullish for crude, but I think it will be offset by other pieces of the pie, which is large and not scarce when you think about it in a global basis. And that brings us back to the ESG. You know, it's how the market defends itself. I mean, you have even coal, which is the bad brother here, the dirty one. You know, how the cheaper it is, it incentivizes clean coal technologies and other ways. So it's almost like you want to find, you know, I think this mix will remain there for a reason. All the pieces will play some role, but those silos are being broken, and that means, to George's point, modeling certain things is virtually impossible with this volatility of demand, supply, and substitution. But some of the bigger trends that Nuno described are very much in place, such as EV and others.
So I mean, I focus more on natural gas, and natural gas also has a higher supply and demand sensitivity to price. It has a much more elastic demand. So, you know, natural gas has dropped considerably because of, you know, warm winter weather forecasts, but also I think it was partially because in the election we just had in the U.S., there was a lot of market participants expecting a blue wave with Democrats taking, you know, full control of Congress and the presidency, which did not happen, and there was a lot of participants that just had to, you know, just left the market after that. So that whole idea of what's going on in the oil market, from supply not being incentivized on the natural gas market, we also have a lot of more demand being incentivized as prices have fallen by almost $1 or probably over $1 in some parts of the curves. So, and on the other side, like we talked about COVID earlier, natural gas is not as affected by COVID because, you know, unlike oil, where transportation is a big part of demand, natural gas is mostly heating and cooling. Right now, it's mostly heating, and with the fact that there's a lot of people working from home, now you have the need to heat the homes and the office. So there's actually an incremental demand for the same amount of weather for natural gas because of COVID. But the idea is that we have a supply issue and we also have a demand issue, which in our case is actually positive demand. So because of COVID, we probably will have more demand for natural gas. And that goes back to the market being, you know, out of balance with these low prices. Even though these low prices are being driven by, you know, the short-term weather forecasts, if you move ahead forward into the curve, you will see that the curve is way out of balance. So all of these things will play out because, you know, they have to, you know, the market has to balance because natural gas has, you know, specific constraints that we cannot get around. You know, we have to have enough gas for next winter, and we have to, you know, be able to, you know, not run out of gas by March 2022. So prices will have to adjust to that, or something else has to happen. But it goes back to the idea that you cannot, you know, prices themselves are, you know, like Diego just said, prices themselves are somehow protecting these markets from, you know, the ESG revolution. So they're allowing these markets to, you know, maybe survive for a few more years because, you know, we cannot just remove them from the stack immediately.
Regarding investment opportunities and turning back to the value growth rotation, I think that will be one of the key drivers of the performance of energy sectors going forward. Adam in the last panel just focused on 80% of the assets in the S&P being intangible. The issue for me is that have we gone too far too fast? So we all know that COVID brought forward a lot of investments in technology, cloud, software. The issue or the question is, you know, the pent-up demand and the new normal, old normal, how much it will impact the demand for one, energy stocks, oil in itself, and a lot more people, I would say, are using commodities, commodity futures, and CTAs to diversify their portfolios. Because, you know, if you look at the 60-40, everyone is thinking, what should I do with the 40, right? Bonds are paying
and the
like
60.
And the 60.
Yeah. I was not, you know, that would imply the equity market is over or undervalued.
Ooh,
I wouldn't go too far on that. Yeah, but at least the 40 is definitely a challenge, and we know the issues with gold. I think got a bit crowded in August. We all know the benefits of crypto as a diversifier, but are people ready to put 20% of the portfolio in crypto, maybe 1 to 5? I'm not sure if they're putting 20%, not even in gold. Of course, real estate is an alternative, but all these, like, except crypto, even gold has been having beta. Gold and silver have been behaving, at least until a couple of weeks, just like stocks. It's all the same trade. So that annoys me a bit, but that should make CTA's managers happy, because commodities are really a diversifier and should protect against inflation. So, you know, there's a few, so like we all learned, value should outperform growth in the long term. We've been waiting for 10 years. So I'm not sure there are many value managers out there able to capitalize on this opportunity. Small versus big caps, we know how it has worked, at least until recently as well. But momentum is the factor that has been working, and science, let's say, or the studies prove to work. So I'm very curious if these energy stocks or the energy sector in general has been, like, you know, is now momentum. I think ESG stocks are momentum. If you look at solar and wind, definitely. Again, not sure if it's too far, too fast. And of course, like value and growth, it's an oversimplification, because as we've talked, and I talk frequently with a friend about that, we have learned recently that there's a lot of value in these growth stocks, especially the software names, because we can't predict the earnings, and no one was seeing this. And maybe we saw the next, like, 3 years or 10 years of supposedly consumer behavioral change, namely in e-commerce, but again, cloud and software happening 3 months. So apparently there was, and maybe still is, who knows, a lot of value in these stocks. But intangible assets are much harder to quantify. If you look at hard assets, energy is definitely, and energy stocks, very cheap. And if you look at wind and solar, I wouldn't qualify them as cheap, but energy pure, more like oil or refiners, or even oil services, they're the big one. But I don't think the trade is crowded. People say, oh, value is now crowded. I think the FANGs or fund mags are still way more crowded than the energy sector. But if that crowdedness contributes to momentum, that should help a lot these energy stocks to outperform going forward.
Thanks, Nino. We got one question from the audience, and then we're going to move on to the next panel. So panel, what can you say about the uranium market? It seems that small modular nuclear reactors recently have started getting more attention as reactors may help the economy become greener.
If I may take that
Anyone got a
one,
view on uranium?
yeah, I have, if I can take that one, that would be my next point and last one. I think uranium might join the ESG soon. Nuclear is the cleanest and safest, arguably, source of energy, and people have been forgetting about that. And I think nuclear will have a particular significant role supplying the electricity that will be needed to those EVs and batteries. Full disclosure, I have position in uranium stock, so I'm talking a bit my book. But I think it's a very interesting opportunity. The metal itself has not gone up a lot, but the stocks have been going up quite a lot. And I would just add one more thing regarding renewable energies. You look at emissions in France and Sweden, and you look at how much gone they have been. And France, 70% of the energy in France, the electricity production comes from nuclear. And you compare to Germany. And Germany usually, actually has been shut down nuclear, they're now reverting, but nuclear plants, and they had to rely more on coal because of the instability of the grid. And I have like an impressive number. On 3 days during June 2019, Germany had to import 6 gigawatts of electricity to avoid power cuts. And they cost like 40,000 euros per megawatt, when usually the cost is 10 euros. So there can be massive problems of instability in the grid, because we all know the sun is not out 24 hours a day, instead apart from in the poles half a year. And we all know wind changes. So nuclear is much more stable. So I'm quite bullish in uranium. I think at 40, it's 40, 50 is break even for most of the companies. So at 25, it's a matter of supply and demand. And there's many people say the cure for low prices in commodities are low prices, and the cure for high prices is high prices. So I'm very bullish on uranium and uranium companies. Small modular reactors would be a whole nother story, but to keep the story short, I think uranium will be needed more and more, and with emerging markets and a lot of small modular reactions and traditional reactors under constructions in emerging market, China, Pakistan, they have to be front-loaded. The uranium needed to front-load them is a much more than to maintain the current ones. And I think there's no way the utilities will be able to contract at current spot prices, which are 25. The producers won't sell it. So 40, 50, I don't know. I think we can have a huge uranium bull market starting just right now.
I don't know if I may just add to link back to oil and others, and to the commodity versus commodity equity discussion. I think something, we need to understand the cycles, how long it takes to build a new power plant or nuclear plant relative to how long it takes to build a mine. And this is something that works both ways. So part of the reason why the oil market has changed is, if you wanted to produce, oil out of Alaska, pick your number, but we're talking anywhere between 10 to 15 years before you see the first drop of oil. Everest will know very well that how long that takes for nat gas, fracking or oil. That game is dramatically changed in the terms of speed and the ability to close the tap and stuff. And I think with nuclear and uranium in particular, you have that dynamic. You obviously have so much visibility about the demand that you can actually respond with supply way quicker. And one of the most obvious and important commodities, an extreme one, is shipping, where this cycle just becomes boom bust in very short periods. So very nice way to complement the discussion between spot and forward markets, equity and commodity, and the flattening across energies. I think uranium is crucial. It will play a big part, but mind the basis and the timelines.